Good morning. My name is Francis Brooke. I am the Vice Chairman of Troy. I handed over my fund management responsibilities at the end of last year to take on this new role. And I'm just going to introduce the speakers today at our sixth investment trust seminar, which we're delighted to welcome you all to. Some of you may have been here before. Some of you may have listened to the webinar last year, which we did and had over 400 listeners. This will also be recorded and put out on the website later, so you don't have to take extensive notes. You'll get another chance to hear all the words of wisdom which are going to follow. Firstly, investment trusts, as you know, have been a very important part of Troy's development. We were lucky enough to be appointed to two trusts in 2009, Personal Assets Trust, which was then 171 million, now 1.8 billion. Troy Income and Growth Trust, also in 2009, which is a UK equity fund, which was 43 million, now 223 million. And in 2020, we were delighted to be appointed to as managers to the Securities Trust of Scotland, a global income mandate, which is run by James Harries and Thomas Boniak. And we're delighted to welcome, firstly, nearly all our investment managers here today. Charlotte Young is not here because we were delighted that she had her first child recently, Alfred, and we look forward to welcoming her back in a few months' time. But basically all the other managers are here, and you can talk to them later or ask questions at the end in the Q&A. We also have representation from all the investment trust boards. So again, in the Q&A at the end of the presentations, there will be opportunities to ask chairman or directors of each trust questions about the board structure or other issues that you want to raise, as well as asking the investment managers questions about the portfolio. And then the last element that I'm just going to discuss is something which is common to all our trusts, something which is actually really part of the DNA of Troy's approach to running investment trusts, and really comes back to that key quote at the bottom of that page that Robin Angus famously said years ago, which are discounts are voluntary, not something that everyone agrees with in the investment trust industry, but something which we feel very strongly about. And all three trusts are committed to discount control. Pat has done it since 1999, Troy Income and Growth Trust since 2010, and Securities Trust of Scotland since 2020. And this basically, in our view, improves liquidity for investors. It actually enhances NAV over time as you're buying at a small discount, issuing at a small premium. It reduces clearly the discount volatility, which is a fairly pernicious element of investment trust investing for many people. And over time, it really does help to bring the costs down of running the trusts. So in every way, we think it's the right way forward. And it has enabled all these trusts to grow quite considerably over time. I mean, over the last 10 years, Personal Assets Trust has grown by two and a half times in terms of shares in issue. Troy Income and Growth Trust has almost doubled in shares in issue, although more recently we have been buying back some shares, but that is a feature of the process and one that has to be accepted. And we are delighted that Securities Trust of Scotland has already started to issue new shares. So I'm now going to hand over to Sebastian, who's going to talk you through the latest on Personal Assets Trust.
Thank you, Francis. Good morning, ladies and gentlemen, fellow shareholders. Delighted to have a physical meeting after a 3-year gap and to see so many familiar faces. So Personal Assets, just a reminder, it's an unusual trust, which is here very much for shareholders to entrust their irreplaceable capital to us for the long term. We try and align our interests as much as possible with our investors, as does the board, and that has always been the case. As Francis mentioned, we've had a discount control mechanism now for over 20 years, and I'm pleased that others have followed, particularly the two trusts and the board the boards of those two trusts have entrusted us to make that decision, which has been very much to shareholders' benefit. You will have seen in the report and accounts, which was published, I think, earlier this month, that Personal Assets is proposing a special dividend, which I'll come on to a little bit in my presentation, and also a 100-for-1 share split, subject to shareholder approval at the AGM in a couple of weeks' time. In the latest Money Week podcast, Dylan Grice, a well-known commentator and strategist, described Pat and our multi-asset approach as a cockroach portfolio for all seasons. I'm not quite sure if that was flattering, but it shows you that I think that Pat is about winning the battle of investment survival rather than maximizing the upside. So the world has changed. After 13 years of what I've described as the phony financial world, we're beginning to see reverse that. We're beginning to have a painful journey in terms of a return to some semblance of normality. On the left-hand side of this chart here, you will see the Fed balance sheet in red, and you can see how during COVID in 2020, the Fed expanded its balance sheet by 2 times. But there's a very material difference from the very material increase during the financial crisis in 2009, which is that effectively this time around in 2020, we've had what some commentators have described as modern monetary theory light, or MMT light, whereby before printed money found its way into asset prices, this time around, due to fiscal stimulus, it's now boosting retail prices, which has very material implications. And what that means is we're moving into a new regime of higher interest rates and arguably higher inflation. I'm reminded by Sir John Major's phrase, "If it isn't hurting, it isn't working." And this is not some sort of brave new world, but rather actually a return to normal and the reality of a higher cost of capital. The era of concept capital, where free money flowed into profitless technology companies and growth, has, we feel, come to an end. This has been a difficult environment, a reset, if you like, that began earlier last year and has run through markets for the last 18 months or so. On the right-hand chart, you can see the US debt to GDP, which is at World War II levels following the pandemic. US government debt has increased threefold from $10 trillion to $10 trillion in 2008 to $30 trillion today. So it will take a long time to normalize. Quite clearly, central banks cannot normalize interest rates to the sort of levels that we were used to prior to the financial crisis very quickly. So one thing that will not change is, in my opinion, is that financial repression is here to stay. And what I mean by that is negative real interest rates. And you can see that here, the UK RPI number, which last month was 11.7%, compared to the very, very modest increase in interest rates that the Bank of England has put in place from 0.1% in 2020 to 1.25% today. That gap is the widest since the 1950s. And I think it highlights central bankers like Andrew Bailey, the governor of the Bank of England. They're in an invidious position. They tackle inflation by raising interest rates, but that leads to weaker growth. And he showed the weakness of his hand a few months ago by calling for wage restraint, something that the RMT didn't really get the memo. He knows that tightening with such high debt levels will tip the economy into recession. But if wages become ingrained, wage growth becomes ingrained, then future inflation becomes more embedded. Effectively, they are between a rock and a hard place and in a trap of their own making. So this era of negative real rates is here to stay. The idea of some Paul Volcker from the 1970s and 80s, the chairman of the Fed at that time, moving to positive real rates, we think is simply unpalatable, despite all the talk of it. So the pandemic bubble, which was fed by QE and zero rates, the second bubble in my career, is now deflating. Valuations have fallen from their peak in November 2021. This is the cyclically adjusted price-earnings ratio. It's one I've used many times at Pat. You can see there, hopefully, there we are. So this is the peak during the dot-com bubble here in December 1999. The PE on the US stock market over 10 years of earnings was 44 times. In November 2021, it was 38. And since November, it's fallen by 10 turns to 28 times. So it's begun its journey downwards in terms of valuations. Now, stock markets, historically, as they did in 1999, peak in periods of modest inflation, very low interest rates, loose monetary policy, and high expected growth. Today, we have rates rising, we have rates rising, we have rising inflation or high inflation, and we have declining levels of growth. This is not a great combination for stock markets. And you can see here, actually, the long-term fall in the long-term bond yield, which is the red line, which peaked in 1982 when real yields were positive, has been falling for the last 40 years. And you can see there the trend has broken and long yields have started to rise. In some more speculative areas of the stock market, as we've seen, falls have been pretty savage. But there's a material change to what happened in 2000 and in 2008, is that there are actually fewer places to hide after 10, 13 years of QE than there were before, because bonds are falling with equities. So for the past 40 years, during that fall in the 30-year bond, the 60-40 portfolio has been a phenomenal place to be for private investors, for family offices and institutions alike. And effectively what this provided, this 60% equities, 40% bonds, it provided a sort of yin and yang. So when equities performed poorly, bonds tended to perform well. And what you got was the green line here, which is really good risk-adjusted returns of about 6.6%, but with annualized volatility of just under 10%, 9.5%. Whereas if you look at the equity return, it's not that much higher, 8% a year, but you've had annualized volatility 50% greater at 15% a year. So actually, this was a wonderful combination for investors. But unfortunately, that combination is now turning toxic as bond yields rise and equities fall. In previous bear markets, particularly during the dot-com bust and during the financial crisis, that barbell worked incredibly well. And you can see the low volatility of the green line compared to the blue line. It provided a great deal of comfort. And unfortunately, this time around, there is no bond insurance to portfolios. You can see that in the performance year to date of equities and bonds, both down. And commodities, gold and cash have been the only game in town for those seeking protection. And to put this into context, personal assets is down 3% year to date on a total return basis. So how on earth do we navigate this new, very challenging environment? Well, for Troy and for our multi-asset portfolios, like personal assets, it begins with careful stock picking. The best way to preserve, in terms of preserving and growing capital in the long run, is aligning our portfolio with management teams who share the mentality of building the business over a long term. And in personal assets case, we very much build a portfolio from a bottom up, from an equity perspective first, and then we complement the other assets. In the past, those have been bonds, gold, and cash. Today, it's more about index-linked bonds rather than fixed income, and I'll come on to explain why later on, but hopefully that should be obvious. And we've always had a very careful, qualitative stock-picking approach, which all of us, the 14 of us in our investment team, which Francis alluded to earlier, all very much believe in and work towards on behalf of our clients. As I mentioned, we don't hold conventional bonds, but there are other asset classes which complement the equities and offset the equity risk. First, TIPS, Treasury inflation-protected securities, but also gold, which I'll come on to talk a little bit about, and cash. And cash is dry powder. What was remarkable is when inflation starts to rise, many investors said, well, the one place you don't want to be is cash. And actually this year, that's precisely where one should have been, because all other asset prices were overextended. So I think what we're trying to say here essentially is that we keep it simple from the point of view of personal assets. We don't use exotic derivatives. What you see is what you get. On the left-hand side here, you can see a carve-out of the equity performance of my mandate, the multi-asset mandate, going back to 2001 when we launched the fund. And clearly, personal asset shareholders have been beneficiaries of this since we won the mandate in 2009. But I think what it demonstrates is that we are good, qualitative stock pickers, and importantly, we endeavour not to overpay. So roughly, over the last 20 years, 60% of the returns in this mandate have come from equities, but 20% have come from fixed income, index-linked, and then some from cash, don't forget foreign exchange, and gold as well. So what makes Troy different in the terms of how they go about picking stocks? Effectively, very importantly, since I launched this mandate back in 2001, we have had a high hurdle in terms of investing in companies. We are careful in the companies that we select. We do not want to invest in wasting assets. We don't want to invest in companies that are challenged by technological disruption. And importantly, we're not traders. We like high-quality businesses, durable franchises that have been around for a long time and will continue to be around for a long time in the future. We avoid excessive debt, cyclicality, capital intensity, companies like retailers, airlines, and banks. Now, usually at this stage in the presentation, I start talking about British Airways, or IAG as it's known, which has been a dismal investment since I started in the city. But I thought today, for a change, to bring the changes, I thought I'd use Marks & Spencer. And on the right-hand side, you can see very clear reasons as to why we don't invest in M&S. To remind some of you, Marks & Spencer share price peaked at £7.80 in 1997. So it hasn't been a great investment. Today, it's about £1.50. But in terms of metrics, you've got return on invested capital, which is in single digits. You've got margins, which are in low single digits. You've got debt, which is high, 4.5 times. Often mature businesses have excessive debt, which leads to lack of flexibility. You had a drawdown during the pandemic, share price of over 50%, clearly something we don't particularly want. And finally, due to the Ocado deal that they did a few years ago, they increased the number of shares in issue by 15%. We like companies that are very careful with their equity and don't dilute us. And actually, it was a very big test for us during the pandemic. None of the companies, the stocks that we hold in personal assets at the time, raised new capital or needed to raise new capital, whereas many companies did. Compare that to a core holding that we've had since literally within a month of taking over the mandate of personal assets at Nestlé. High double-digit margins, strong operating margins, net debt very comfortable, a drawdown during the pandemic of a mere 6% in sterling terms, partly thanks to the strong Swiss franc. And then look, almost most importantly, number of shares in issue down 10% over the past 5 years. Compare the right hand with the left hand. Nestlé's up almost 60% over the last 5 years. M&S is down 50%. I think Nestlé is about the closest you can get to a cockroach stock. Moving to the rest of the portfolio, I mentioned TIPS, Treasury inflation-protected securities. And here you can just see the difference between what a TIP gives you compared to what a conventional bond gives you. On the left-hand side, you can see you get your principal back in 10 years' time, not protected by inflation, and you get your income, which is not protected by inflation either. On the right-hand side, you've obviously got, if you have 5% inflation over 10 years, you get 63% gain on your capital in terms of your principal, and also a gain in the income as well. And this is the reason to note, if you're reading the accounts, why we paid a special dividend because effectively the income and the capital growth, which is actually counted as income, rather irritatingly, that boosted the income account very materially last year, and that was the reason for paying the special. But importantly, currently TIPS are yielding +1%, so +1% real. So we think that they still will provide good real protection in a period of higher inflation. It's certainly better than conventional bonds. And then last but not least, gold, which remains a core holding but not a permanent one. And while real yields remain negative, gold remains essential portfolio insurance, especially when bonds are not up to the task. Now, some might say, well, hasn't gold been a bit boring recently? And I think the answer is yes and no. Depends what currency you're looking at. And most people look at gold in dollars, and that may or may not be a mistake. This is a chart on the right-hand side of the 4 major currencies which are of note. The yen in green, sterling and the euro in red and blue, and the dollar in gold. And what you can see here is that in most currencies, with the exception of the US dollar, gold has been very resilient this year, up 10% in sterling terms. So effectively, in a period where markets are febrile, falling, it's doing its job for us. And the test over cryptocurrencies, for now at least, seems to have been won. Crypto has been highly correlated with the NASDAQ and other risk assets. Gold has proven to be a store of value over 6,000 years. Crypto still remains unproven after 13. So finally, where are we? We are very defensively positioned. As you can see on the left-hand side, we've got 35% in equities compared to a range of 31 to 74 over the last decade or so. We decreased our equity exposure before these recent falls, taking it down during 2021, not by enough, I hasten to add, but in hindsight, but still we did prepare for more difficult markets, and the balance obviously at relatively near highs in terms of the index-linked bonds, both gold and cash, having our dry powder ready to exploit opportunities as they present themselves. And I think we are at the bottom of the range in terms of equities now. I would expect and hope that our equity exposure will rise over the next 18 months. Now, what of the outlook? Francis always says at this point, Sebastian, you must offer a bit of hope, even if it's a sliver. We may be in capital preservation mode at Pattern. As you can see, I think that's appropriate. But today, there's good news. Falling markets do offer better valuations. The stronger businesses, as we are seeing, are surviving and thriving. Future returns, actually, from lower markets mean improved returns. That's what happened in 2001, 2002. It's what happened in 2007 and 2008. In 2008, when the CAPE was at, cyclically adjusted PE was at 15 times, I've mentioned earlier, today it's 28, we were 75% in equities. So it gives you a flavor of the fact that we can really pivot the portfolio when the value is on offer. So the equity allocation will depend both on what's available within equity markets overall in terms of equity indices, but also specifically in the kinds of companies that we like. And what you've got to realize, and what we've got to realize, is that as stock markets fall, we become more optimistic, not more pessimistic. And with that, I will pass over to Blake to talk about Troy Income and Growth Trust.
Well, thank you, Sebastian. And I think that's a good time to talk about an equity trust with that glimmer of hope just at the end. My name's Blake Hutchins. I'm co-manager with Hugo Ure, who's with me today, of the Troy Income and Growth Trust. Troy has been managing this trust for over 13 years, and we have always done so with a very simple aim: to deliver above average returns with below average volatility. And that is exactly what we're trying to do today and in the future. It's very clear what we represent. We're a UK trust that focuses on quality income growth. We invest in exceptional businesses, just the same as Sebastian, that are resilient and that can grow their dividends almost in any environment imaginable. Exceptional companies that have resilience and that are able to grow their dividends. And the good thing for me, fortunately, and frankly we wouldn't be doing this if this wasn't the case, is that the UK is home to various businesses that can do just this. At Troy, we invest from a clearly defined investment universe, a global investment universe of around 150 companies. And in the UK, we follow 70 plus companies that have these characteristics that I've just described. 35 of them are held across our UK strategies today, such as the Troy Income and Growth Trust. And you can see some of them on the left-hand side here. Companies such as Diageo, the world's leading international spirits company, owns the brands that many of us enjoy and admire, Johnny Walker, Tanqueray, Baileys, and the like, affords them great pricing power and affords them great resilience in times such as these. And then if I just highlight Croda, a newer addition to the trust. A couple of years ago, Croda is one of our leading specialty chemicals businesses in the UK. They actually produce ingredients that go into a range of products, such as beauty products, anti-aging cream, sun cream, not that we need it on a day like today, but they also produce ingredients that go into pharmaceuticals. If any of you have taken the Pfizer COVID shot, which I certainly have, it is Croda's stabilizers, their nanolipids, that are so important in the formulation of these incredible vaccines. And Croda has a very, very bright future in terms of future development of future drugs. So those are some of the 35 businesses that we own in the trust today. But we also follow a further 35 plus companies that we don't own today. And that gets to Sebastian's point. As valuations are coming our way, we're obviously dusting off our research, of which we have a rich bank of research on some of the companies such as those on the right-hand side. If I highlight the LSE Group, one of our largest companies here in the UK, owner of the FTSE indices, which we all know very well. Also owner of various data assets that many of us as financial professionals use on a day-to-day basis that are becoming more valuable to the way that we work. Or just Spirax-Sarco, we would argue the UK's leading engineering business, really well placed in today's world of energy efficiency and factories and customers really focusing on energy efficiency through their products and their solutions. They're absolutely paramount to their customers. So the bottom line is, what I'm trying to tell you here is that the UK is home and still is home to various world-class businesses. Now, the thing these businesses have in common, amongst other things, is their ability to produce recurring, resilient, growing cash flow. And that growth and that resilience of cash flow is the bedrock to resilient, growing dividends. We find companies in our investment universe that have low levels of cyclicality and low levels of capital intensity, because these are the companies that can endure and continue to generate that free cash flow and those dividends come what may. And in fact, if you look at the red side of this chart, that cross-section of intense capital intensity and intense cyclicality, these are the companies that we simply do not invest in. They just don't appear on our investment universe. Sebastian has already mentioned British Airways in this chart. We would also put Marks & Spencer in that. But also those industries that are incredibly cyclical, incredibly capital intensive, some of which are actually having their day in the sun right now because of high energy prices, oil companies, banks, miners. You won't find those in the trust. Instead, what you will find are those consistent cash generators, consumer staples companies such as Unilever, which we've owned for over 13 years in the trust, or even those companies that exhibit some capital intensity but no cyclicality, or some cyclicality but no capital intensity, such as you can see in the middle. Intercontinental Hotel Group's a good example, a franchise business model. We all would have stayed in one of their hotels, I'm sure, but they don't own the physical hotels. And so that means whilst demand is variable, the capital they need to put down does not ruin the business. It does not impair investors' long-term capital. And that's what we're looking for in the trust. A great example of a company, and it's actually one of the largest companies in the trust today, that have these kind of cash flows that we value, that we look for, is RELX. RELX is arguably the UK's leading technology company. It is a data business. It has various technology assets, and it also owns exhibitions. And you can see in 2020, clearly, with the pandemic and all of us being locked up for however long we were, exhibitions just didn't happen. Trade shows didn't happen. Events like this didn't happen. And so there was a rare year where cash flow went backwards for RELX. But in general, you can see this business is incredibly resilient to recessions. And that growth in that free cash flow, which you can see in the bar charts, is very much upward trending. And also the free cash flow conversion. This is how much cash does a company generate for the level of profit that they generate. And we love to see cash conversion at very high levels. And you can see here, not just high levels of free cash flow conversion for RELX, but you can also see the fact that it doesn't vary very much at all. So these are the kind of cash flows that really support the dividends and the income behind the Troy Income and Growth Trust. The contrast to that is a company such as this. And if you just eyeball this chart, the bar chart is, again, the free cash flow. The line is the free cash flow conversion over time. And frankly, it's random. It's unpredictable. It's highly volatile. And it is just not something that we can accept or build a strategy around for you and our shareholders. This is Anglo American, a mining company. You will note that in 2021, just how high and unusually high those free cash flows are. And it's little wonder that Anglo American has had good share price performance of late. But frankly, if we roll forward a year or two, it's anyone's guess what that number is, and it's any guess what their dividend is, quite frankly. These are just not the companies that we rely on to pay dividends to our investors. Instead, we focus on quality income growth. So where do we find those opportunities? If you just walk around the wagon wheel, you can see about 25% of the portfolio are in consumer staples companies. We've talked about a few of them already: Diageo, Unilever, Reckitt Benckiser, Nestlé, as per Sebastian's presentation. 10% of the trust is in healthcare, AstraZeneca, GlaxoSmithKline. 20% are in more technology and data assets, which we like. About 10% are in these specialty engineering chemicals companies such as Croda, 9% in asset-light consumer discretionary stocks like IHG, and then about 10% to 15% of the trust are in slightly more asset-intensive areas that are incredibly predictable. So companies such as National Grid or IMPP, Assura, PHP, they're the owners of the GP surgeries that we all go to across the UK. They basically get paid rent from the NHS. They have good inflation linkage at a time like this. They have pretty bulletproof cash flows and dividends. So taking a step back, a very distinctive portfolio that you will note looks absolutely nothing like the UK market. And for that, we make no apology, but I will come back to that point just shortly. The top 10 of the portfolio. The nice thing about it, particularly for the retail investor, is that these are names that you would recognize. It's a concentrated portfolio. Nearly 50% of the trust is in the top 10. And we are very much focused in the way that we construct portfolios at Troy. I've spoken about some of the names on this page, such as RELX, such as Diageo, but maybe I'll just touch on a couple of others. GSK, I'm sure many of you in the room are shareholders either directly or indirectly, and I hold out great hope that finally, after 20 years of trying to digest this monster acquisition that was made, and the big merger that formed GSK 20 years ago, you will know that in July of this year, there's finally going to be a separation of the consumer health business from the pharmaceutical business and the vaccines business. And as I said, I hold out pretty good hope from particularly attractive starting valuations that this will finally let Glaxo invest in the way it should. You will know that they cut their dividend this year in order to reset the business for the future, and that is definitely a top 10 holding for us. And as I said, I hold out good hope for better returns from Glaxo from here. And then finally, Compass Group. I mention it because it's very much synonymous with the kind of company that we like. Multinational businesses that are highly diversified, that actually have market-leading businesses in the US. And as a UK investor, I feel very lucky because of our international nature of our economy, of the history of the UK. We do have multinational businesses. And Compass could just as easily be listed in the US because that is where about 60 to 70% of their profits come from. But they are the world's biggest catering company. They buy more food in the US than anyone else in the whole market. And that gives them incredible economies of scale, and it means that they're able to win share from their competitors by undercutting them and delivering better service. So this is just a selection of the kind of companies that you find in the trust. I said earlier that our portfolio is incredibly differentiated from the index, and therefore it is incredibly differentiated from a lot of our income peers. That is a very important point to note. Now, over time, that has very much been to our advantage. You can see in blue the returns of the trust versus the index in red. But you will also note in the bar charts is that in any given year, our returns can differ very materially from those of the index, and as I say, therefore of our peers. In years such as 2014 and 2015, this was clearly much to our benefit. In difficult markets, the trust delivered a very positive return. But then in years like 2016 and 17, when the market rebounds strongly, we tend to leave some on the table. This year to date, as Sebastian said, the only game in town has been commodities. That hasn't helped us. We do not own a single commodity stock in the trust. But as we get into more difficult environment, as resilience and perhaps we get more pressure on earnings and cash flows for the consumer and companies, we think we can rely on the car companies much as we have in the past. So when I analyze a company, I'm always thinking about the interplay or the balance between the quality of the business, the future growth of that business, and the valuation that we are paying for that business. It's almost like a triangle, thinking about the interplay between the quality, the growth, and the valuation, or yield, as I put it here. And I think we should do the same for portfolios, and that's what I've done here. If you aggregate the portfolio, you can see in terms of quality what one is getting. You're getting, on average, 20% operating margins, 20% return on invested capital, which incidentally is about double that of the UK market. And then in terms of growth, and this is where we must take this with a pinch of salt, this is forward consensus estimates, and I don't think it takes any of us to stretch our imagination to think that we're going into a more difficult environment. But the point is, it is very important that we embed future growth within the portfolio in order that future dividends grow as well. And what are we paying for that higher quality, that better durable growth? Well, we think we're paying reasonable valuations. A 5% earnings yield can obviously be inverted to create a PE of around 20 times earnings. And very importantly, that 5% earnings yield is supporting a dividend yield of around 3%. And I'll just dwell for a second on this point on dividend yield. In this uncertain environment where the capital return is uncertain, that tangible return we get from a dividend and investors get from a dividend is likely to be valued even higher than usual. And what I would say about our dividend yield, and you can see here at the portfolio level, is that it's comfortably covered by earnings. That 5 covering 3 is a very good sign in my book. Not only because it says that the dividend is sustainable, but it also is saying that our companies are, on average, retaining 40% of their earnings to reinvest. And why wouldn't they do that when they can reinvest at 20%? So 40% times 20% is 8%. I'm not saying we're going to deliver 8% every year, come what may, but on average, that's the kind of mentality that our companies are having. Retaining 40% of their earnings to reinvest at high returns is the fuel for future growth and future growth of the dividend. So that leaves me just to highlight who the trust is likely to be for. Given, I hope, how clear I've been as to what we're trying to achieve, which is quality income growth in the UK market, you may be able to answer this question for yourself. Most likely it's for that person who's in or approaching retirement, who wants that that reliable income stream, but doesn't want to see their capital erode, that wants to see their capital grow, perhaps to pass on to future generations. Or it could be someone like myself who doesn't need the income today, who uses that dividend to reinvest. And that's a particularly nice feature of an income fund in difficult markets like today, when we're all wondering when we should start to reallocate to equities. A dividend reinvestment mechanism is an incredibly powerful tool in this environment. 4 times a year, a quarter of the dividend yield from the trust will be reinvested back into the market, and that takes the decision away from us and is always a very good engine for long-term compounding, I'm sure you'll agree. So we think it's for those who want that attractive quality income stream, or that person who wants a resilient total return, or even someone who wants both. Finally, who is the trust not likely to be for? Well, we do not strive for high yield. We will not risk capital in order to strive for that highest yield. And we will not replicate the UK market. We think that's what passive funds are for. And you will note you can get a higher yield from the UK market, but we don't like the composition of the UK market. And that option is always there for investors should they want it. And then finally, in typical Troy style, we're the opposite of targeting a fast buck. And so we would always encourage a long-term perspective. With that, I'll just leave you with the 3 key points from my presentation. The first is that we are a UK trust focused on quality income growth. We invest in resilient companies, many of which we have owned for over 13 years, or the 13 years we've been managing the trust, which is reassuring in these uncertain times. And then finally, a well-funded dividend supported by earnings growth that we expect to be able to grow into the medium term. With that, I'll pass on to James, and thank you for your time.
Thanks, Blaine. Well, good morning, everybody. My name is James Harries. I'm the manager of the Securities Trust of Scotland. You've heard a lot about Troy already, but let me just take you through a little bit more about, I'll try and synthesize what's going on in the markets, how we're approaching it in terms of dividends and investing. The Securities Trust of Scotland, Francis mentioned, we won in November 2020. We were delighted to be appointed by the board to manage what we want to be the quality, low volatility, global income trust in the sector. We don't actually think there is another one quite like it, and we think it's a really attractive thing for investors to invest in today, given the backdrop. Now, just to be contrary, I'm going to change the order of the slides. Now, this is to try and put some numbers and some history around what Sebastian was saying, because I think you can always get the impression that Sebastian's pretty cautious right now. And I think that's quite sensible. This is various variables relating to the US economy in 1981 and today. The other remarkable thing about this chart, I think, is that Ronald Reagan looks quite fresh-faced, which probably doesn't say a great deal for Joe Biden. But if you look at it in 1981, it was actually a fabulous time to be investing. Didn't feel like it. It's been through the 70s and the oil shock and winter of discontent and all of that. But you had real value. So you had 14% 10-year Treasury yields relative to, that's at the end of the month, they're about 3% today. You had 14% interest rates, which obviously could come down, because 1981 was the time when equity and bond markets began a structural big upward move, arguably the last of which we've just experienced. Remarkably, inflation in 1981 was 6%. And today, depending on how you measure it, it's about 6%. So you've got the same level of inflation, but you had 14% bond yields, whereas today they're interest rates, whereas today they're 1%. I mean, the difference is remarkable. You had much lower levels of debt. You had much higher levels of savings, which could come down, obviously, to augment consumption. You had much, much more attractive valuations. Sebastian showed you that Schiller Cape, that long-term PE. It was sub 8 times back in 1981. It's still about 28 times today. And finally, the baby boomers were 26. So they were just about to embark on buying houses, having children, basically consuming, which drove the economy. Today, the opposite is true. The average baby boomer is now retiring, which has implications for consumption and spending and so on. So it's just a very different world, and one in which we think you should be fairly cautious. And this is reflected in the bond market. So I'm saying here that interest rates are interesting. I know that everyone doesn't think that, but I certainly do. The 2-year note in the US, which is effectively the short-term interest rate, has gone from virtually nothing to over 3% in a matter of weeks. I mean, that is a truly remarkable event, and ties in directly to what Sebastian was saying. The world has changed. The era of free money is over. And that has real implications for companies, for investors, for economies, It's just a real change in how we've been operating for so long. But what's interesting to me is whereas the short-term note's gone very quickly to 3%, the difference between the 10-year note, i.e. longer-term interest rates, and shorter-term interest rates has actually been falling. So whereas short-term interest rates have gone up very quickly, longer-term interest rates have gone up much less quickly. And that so-called inversion of the yield curve usually precedes a recession or a big slowdown. And it's one of the only really reliable, it's not always right, but it's a very reliable indicator within what is a very uncertain world. And lo and behold, we are now beginning to see a slowdown. So once again, it's a time for caution. So the question is, what do we do? Well, we do what Blake said, basically, but we do it on a global basis. So we try and invest in highly resilient, highly predictable, high-quality businesses. This is what Troy is known for. We try that and then use those to develop above-average returns with below-average volatility. Now, volatility matters, because if you're young, volatility is your friend. High volatility allows you to buy assets more cheaply, and you've got plenty of time for things to come right. With the greatest of respect, when you're not quite so young, volatility is your enemy, because you haven't got time to make up the losses if you suffer steep drawdowns over short periods of time. So we want to be producing decent returns, but with below average volatility. And we want to grow the dividend backed by genuine cash flow, just precisely what Blake was saying. The dividend on the trust today is about 3%. And I would say this, wouldn't I? I don't think you'll find a higher quality growing 3% yield anywhere. Finally, Troy being a competitive place, Sebastian put up a chart showing that the US market was pretty fully valued relative to history. So I've got 2 charts up showing that the US market is relatively fully valued relative to history. Shirley Cape on the right, and the US market cap, i.e. the overall valuation of the market relative to GDP. So market valuation relative to economic valuation, if you like. And it's above, shall we say, it's pretty high. And Warren Buffett describes it as his favorite single indicator of the value in the market. And so it would suggest to us that it is a time for being a bit careful. So what do we own? Well, we own a selection of businesses that, again, very similar to what Blake would say. So we have exposure to branded consumer goods. We find these businesses to be very resilient, very predictable. They've dealt with inflation in parts of the world like emerging markets for decades, and they just tend to be, we think, remain very attractive businesses. You might say, but aren't they suffering from rising input costs? The answer is yes, they have been, and they've suffered some margin squeeze as a result of that. But actually, first of all, the market's been remarkably efficient in rewarding businesses which have got pricing power, like Hershey is a chocolate business. You don't really think about the price of a bar of chocolate when you buy it, you just want it. Whereas others, such as Unilever, had a bit more difficult time, but there are a few other things going on there too, obviously. But my point is, I don't think input costs can keep going up at this rate. After all, if oil price continues to rise as quickly as it has been, we are going to have a crunching recession. But it also means that if the input costs are beginning to ameliorate, these companies have taken price. Today's margin squeeze is tomorrow's margin expansion. They may actually be very well positioned. We have exposure to platform businesses, Chicago Mercantile Exchange, hotel group that Blake mentioned, Nintendo. We love Nintendo. We think it's a really interesting global income idea. We have exposure to software, and we have a group of world-class businesses that we've grouped together as historically dependable income, which I'm sorry doesn't mean a lot, other than they are actually world-class businesses, and we're very happy to have them in the portfolio. We have a global portfolio. It's taken me years to realize it. One of the great arbitrages, in my view, that investors can avail themselves of is to live in the UK, because it's fantastic, and invest in the US, because that's where they make all the money. And that's been true for a long time now, and I think that is an opportunity that you can take advantage of in this trust. So you can see half the portfolios in the US. That's going to be the case, I suspect, forever. We find it to be the best economy. We find them to be the best companies. We find the dynamism of that economy and the way in which they're respectful of shareholders' capital is just a fantastic place to invest. We do also have 25% in Asia and emerging markets. The ex-CEO of Unilever always used to say, you've got to invest in emerging markets because that's where all the people are. And it's true. And so we do have some exposure there. And our companies will be allocating more money to those countries over time because the margins are attractive, because of the growing middle classes and so on. Now, Troy is known for doing relatively well in more difficult times, and we are demonstrating this in our strategy as well. I've been saying until quite recently, until the recent drawdown, isn't it remarkable? There's only been 3 drawdowns of more than 10% since I launched the strategy at Troy in 2016. I think there's now a 4th, actually, so I have to update this chart. One of them is pretty short and sharp, I grant you, COVID. But in each of them, we've done rather better than the market, which is what one, I hope, would expect to see. So what are we left with? Well, I always think this is the most important chart in the book, in a sense. We are showing on the left-hand side valuation metrics, PE, free cash flow yield, what a company can pay out to its shareholders after funding the business. Yield, and on the right-hand side, some metrics showing that we are compounding capital at a rate that is higher than the underlying market. So it's a high-quality portfolio. The point is, we think, because of the resiliency and predictability of the sorts of businesses in which we have, that 5% free cash flow yield should grow at around 5%. And if you think in terms of a forward expected return, 5% free cash flow yield growing at 5% should give you, not guaranteed, not every year, not in a straight line, about 9 to 11% per annum. So if we can deliver a 3% income yield for people to cover their day-to-day expenses and double their capital every 10 to 12 years via the rule of 72, well, that strikes me as a pretty sensible place to be allocating capital. I mean, I would say that, wouldn't I? And I would always think that's the case, but particularly today. And actually, my personal 16-year track record, that's pretty much what I've delivered over that time. So the chart, most of this chart has nothing to do with me, because obviously we were only appointed in November 2020. But the performance has been pretty respectable since that time. So I hope that's given you a clear idea of how we're investing in this trust, what we're trying to achieve, and to the risk of repeating myself, we wish to be seen as the quality, low volatility, global income trust in the sector. So I think we're going to have some Q&A now. Thanks very much indeed.
Great. So thank you, Sebastian, Blake, and James, for your presentations. And we have roving mics in the audience, Xenia, Antonia, and Georgie. So please, if you have a question, could you wait until you get the mic, indicate whether you would like to ask one? Any? Georgie, down at the front here. And just to remind you, we have got representatives of all the boards here, so if there's a question about board-related matters, please do ask that.
A question for Sebastian, please. I think you're holding US TIP, so the US version. Are you likely to move into UK index-linked gilts in the near future?
No. We used to own UK index-linked for a while, up until about 2000. We started selling them between about 2016 and 2018. Effectively, I didn't have a chart on this, but what had happened, which is due to technicalities regarding the UK index-linked market, which has been boosted by asset matching by pension funds, is that the real yields on UK index-linked have been ground much lower than in the US. So in the UK, the real yields got down to about -3% at one point, i.e. you were going to get an annual return of less than 3% below the rate of inflation. In the US, we've been buying them in positive real yields. As I mentioned, at the moment, they're at about 1% positive. So we think there's much better value in the US than there is in the UK. The other point to mention is that, I think rather surprising, but nevertheless we've been a beneficiary of it, which is that actually the UK inflation rate and the US inflation rate have actually been quite similar. And that's actually very unusual. The UK is actually renowned, when it was the sick man of Europe, but it's renowned as having a higher rate of inflation than the US. And actually that's not the case since the pandemic. The pandemic and the fiscal stimulus, which was put in place by Biden back in 2021, meant that essentially the inflation rate in the US was actually very, very similar to the UK. So we've had, as owners of TIPS, we've had the benefit of that, and we'll continue to have the benefit of that. So I'm not planning to buy UK linkers. Never say never. I mean, it's just a question of value differential. We just think there's much better value in US TIPS today than there is in UK linkers. But if that reverses, we're open-minded.
We'll take this gentleman first, yes.
I just wanted to ask you, I saw you mentioned Glaxo and Roche, but I didn't see any US pharmaceutical companies or like Pfizer, the obvious ones. Any particular reason for that?
Not particularly. We hold J&J, which obviously is a healthcare company as opposed to pharmaceutical. We have the Swiss pharmaceuticals, but we find them to be more attractively valued at this point in time.
Sebastian, about the rationale for two disposals. One was Philip Morris. Was it ethical or business? And the disposal of Berkshire Hathaway. What do you know that Warren Buffett doesn't?
Probably very little, actually. Well, we were reducing our equity exposure last year, as I mentioned. We were looking around for holdings that had done really well, particularly post the pandemic. And I wanted to reduce the equity exposure. In the case of Berkshire Hathaway, which has obviously done incredibly well for us since we bought it back in 2008, 2009, I think it's up over fourfold over that period. There's no income from Berkshire Hathaway, as you know. It grows its capital, but doesn't pay a dividend. But the way that you value Berkshire Hathaway, among others, is looking at the book value as an insurance company. And it was right at the top end of its long-term range, about 1.5 times book. So it was very well liked by equity investors back in the summer of 2021. I was looking, as I say, to reduce equity exposure. And the other thing is I am concerned by Warren Buffett's longevity, impressed by Warren Buffett's longevity, but I think he is 93. And time is marching on, and I do think that when he does sort of fall off his mortal coil, I'm not convinced by his successor, who I have seen, and Greg Abel. I don't think he's Warren Buffett too. And I think there will be all of the loyal investors who've been with Warren Buffett going back to the 60s will reappraise their investment in Berkshire Hathaway. So I think it could be in for a very bumpy period when that happens. So for me, looking to reduce equity exposure, looking to reduce equity risk, it was a sort of relatively obvious place to go. In terms of Philip Morris, again, Philip Morris has done really well for us over the recent period. Again, we were looking to reduce our equity exposure. Wasn't particularly ethical, but it was really more a question of sort of combination of valuation, looking to reduce our equity exposure. Doesn't necessarily mean I wouldn't want people to draw conclusions that we would not invest in tobacco in the future. We may well, but that was the reason why.
So I've looked at the returns over both 1 year, 3 years, 5 years and 10 years. And Personal Assets Trust has been pretty consistent over that time, exactly what I want. Troy Income and Growth, far less so. The results, as far as I'm concerned, have been pretty poor over the last 5 years, but looked at the annualised return over 10 years, it's actually been pretty good. But this is very obviously, to my mind, due to a fantastic performance 5 to 10 years ago, which has simply not been replicated. So my question really is, where are we going with it? Is it likely to pull back? And should I be switching my Troy Income and Growth Trust into Personal Asset Trust?
Shall I just start off and then I'll hand over to Blake? I think that the first thing is that Troy Income and Growth Trust is an equity fund which inevitably will have greater volatility than a multi-asset fund like Personal Assets. And there have been periods of time, as you mentioned, where the fund has done well, and over the long period of time since Troy's run the trust, it's produced a pretty effective return. I think what I would say is that over the last 2 or 3 years, the UK market has entered into a very quite a difficult period. Now, this isn't an excuse, but I think that what I would really emphasise is what Blake was saying, is that what we're trying to do here is create a portfolio that can really produce sustained returns and quality income growth. Now, 2 years ago, it was really necessary to make some changes to the portfolio to enable the foundations for that to be reset. Now, what's actually happened is that there's been this huge, particularly commodity boom, at a time when a lot of other parts of the market have struggled. And that has exacerbated the problem, effectively. So I would fully recognise the fact that, you know, it's disappointing after a long period of time to have a difficult couple of years of performance. But I would also say that the changes that were made for the portfolio really had to be made if we were going to sort of produce what we hope will be excellent returns, you know, for the next 5 to 10 years. And the coincidence of this happening at a time when those changes have been costly in a relative sense has been, you know, unfortunate. But I think what we all agree, and I think what we would all like to feel and say, is that the quality of the companies in the portfolio now are the ones that we think are going to deliver returns into the future. So I think maybe Blake, I don't know if you want to comment on that.
Yeah, thanks, Francis. Firstly, I'm sorry that the returns have not lived up to your expectations. Obviously, it's been, when you think about personal assets, it's obviously done an incredible job for shareholders. And it's benefited, obviously, from that move to more global equities, and UK equities have been a difficult place to be for the past while. So having said that, I think we have to try and look forward, and that's what my presentation was about today. Trying to give you an idea as to the kind of companies that are owned in the trust, the kind of companies that will create value, can be able to grow in the future, and why we're so passionate about investing in the UK in these high quality companies. And I'd like to think that some of those metrics I gave you as to what the portfolio looks like today, those high returns on capital, that good embedded growth, that reasonable valuations, hopefully will spell, you know, better returns for you and other shareholders in the future. What I would say is, you know, it's difficult markets at the moment, and in the UK, we are heavily skewed as an index by those companies that we do not own. And so we don't make any apologies for that, because we will invest in this way, come what may. And I think, as I said, as a little, I suppose, you know, carrot, is that, you know, at some point, the market will return to these quality income companies in the UK, and that resilience and that dividend growth that will come through over many years should come to the fore. So thanks for your question, and those are my thoughts. And
I'm also a significant shareholder, so it's very much in all our interests, because we all invest in our funds, to see this return being very positive in the future. But thank you very much for your question.
Unless I'm mistaken, the US dollar's gone up by about 10% relative to sterling in the last year, roughly. That's obviously a very good wind in terms of tips and the US equities. Can someone comment a bit about how much consideration is given to currencies when deciding on portfolios, and maybe speculate about longer term currency changes?
Look, let's see. There we are. So we anticipated your question, sir. But I think that the first thing is that I'm just talking from a PAT point of view, and then James might talk about Securities Trust of Scotland. From a PAT point of view, the US dollar currencies are useful, and during the 20 years that I've been managing this mandate, we have, you know, as I highlighted in the presentation, you know, we made good returns from currency. Yes, we've had a fair wind more recently with the US dollar. That's not always been the case. When I launched the Trojan Fund back in 2001, the Trojan Fund was quite high exposure to US treasuries, and it was quite clear that the dollar was in for a period of weakness in 2002 to 2007. And if you remember, the dollar went from about 145 to over $2 the pound prior to the financial crisis. During all that period, we hedged. And then when we got to over $2 the pound, Francis and I can remember very well discussing this when we were in our office in Albemarle Street, just down the road, and we just took the hedge off, and we benefited hugely from the protection which the strengthening US dollar gave us during the financial crisis. It's one of the reasons why we got a +1 during 2008 was thanks to that very strong tailwind that the dollar gave us. So we do consider currencies. Just at the moment, we feel that we're not hugely enthusiastic about sterling for all sorts of reasons. This has been correct. We do realize, it's one of the things that from a personal assets point of view, we do realize that personal assets investors, and you'll remember this reading your report and accounts, so I certainly do as a patch shareholder going back to the 90s, is that we always used to speak about our UK investors being having sterling liabilities. So we are very mindful of the fact of the currency risk that we are taking. For that reason, for Pat, we are currently 60% in US dollars, US dollar denominated assets. I don't include gold because gold's a sort of slightly law unto itself here, as I explained with the gold prices in dollars and euros, etc. But in terms of, at the moment, we've got 60% roughly US dollar exposure. At the moment, we're about 50% hedged, so we've got 30% US dollar exposure. If sterling were to weaken materially further from here, which I expect it might, particularly with all the shenanigans as to what's going on with the government, but also with the wider economy, and the fact that it looks like the UK's economic growth could be worse than anywhere else in the G7. It's not looking particularly appealing as a currency. Then we will, if we see a further sell-off, then we will just gradually manage and increase that hedge that we have, which isn't very expensive, I hasten to add. But so the answer is we manage our dollar exposure quite carefully. That's where the currency risk is. It's US dollar. We've got a tiny bit of Swiss franc exposure, which isn't really Swiss franc because it's Nestle. We've got a tiny bit of euro exposure. But really the key decision that Charlotte and I discuss every month, and Mark, who's up there, who discuss when we're having our multi-asset meetings every week, we look at the dollar, we look at the exposure, and we decide as to where we want to be. Very mindful of the fact of the risk that we're taking, but also the upside potential that we're taking. And you're quite right, this year, the dollar has given us quite a nice in a falling equity market. The things that have given us, tailwinds or positives have been the US dollar, gold, and our liquidity, basically. Those have been things. So it's been a nice place to be. And I think what this chart neatly shows is that when there is a flight to quality, the dollar benefits. It's one of the reasons why our drawdowns were less and James's drawdowns were less during 2020 during the pandemic, was the fact that we had that dollar tailwind. But James, I don't know if you want to add anything.
I haven't got a great deal to add other than to say in an equity context, of course, I always think you should hold a global income trust alongside a UK income trust because you do have sterling liabilities, but equally you have a wider opportunity set, so they're complementary. But I mean, this year it's giving us, as Sebastian mentioned, a nice tailwind, so our dividend will be up. That's partly as a result of that. Of course, the flip side is true. If you're investing in a global portfolio to create an income in sterling, what sterling is doing does have an effect, and it can either crimp your income or slightly enhance it, but we try and smooth that over time. What we don't try and do is hedge our currencies. Remember, years ago when launching probably the first global income fund in the UK, there was a feeling we should hedge everything back to sterling because it would be easier to sell to a sterling investor base. And my view strongly then, as it is today, is that being able to diversify out of sterling into a range of different currencies is a benefit to investors. And I think we're seeing that this year. And I would echo Sebastian's comments that the UK is a twin deficit economy. It's got a current account deficit and a fiscal deficit. and it therefore is, so should we say, somewhat vulnerable. But so I think that that's why you should hold both a UK and a global trust.
Given that it's been obvious that things could get quite ugly, I'm quite surprised that the sort of cash position is relatively low, sort of 1%, and I think 4% in PAT. Is that because you have invested, because your firepower is not massive at the time, at this moment?
Is this for personal assets? I'm afraid that's a misconception, in that we've actually got about 20% in cash. But yeah, I know, but that's because we hold UK Treasury short-dated T-bills, which quite rightly the board only allows to hold a certain amount of cash in the bank. And so, sorry, it's all the way back here. So where's the asset allocation? Go for miles. So cash, I would view. Sorry, it's a little bit further on. Here we are. So if you look on the right-hand side here, where it's got liquidity, you can see it's been as low as 1, it's been as high as 29. We're currently at 20. So that's when you think about what liquidity, what sterling cash liquidity we have, 20 is the number, not 1.
Georgie?
Thank you. 2 quick questions about Pat. One, what is the property in the portfolio? And 2, Medtronic and Unilever have gone down. What action plans are put in place when that occurs to one of the stocks?
I wonder if Ian, the chairman of Personal Assets, Ian Ferguson, maybe take the property.
Thank you for the question. I will deal with the property question. I will leave the real experts to deal with Unilever and Medtronic. The property is very simple. It's the office building in Edinburgh, 28 Walker Street. That's the only property asset we have.
Sorry, in terms of Unilever and Medtronic, Unilever's been a very good investment for us, going back to 2004 when we first bought it. Again, Francis and I bought it quite soon after Francis arrived at Troy. I think it was about £11, and today it's about 37, something like that, 36. And it's grown its dividend at 8% per year. And we think that, to some extent, it had a very good pandemic. It performed very well during the pandemic. And then there was some inevitability that when economies reopened, Unilever was probably likely to be rather dull because it's exposed to emerging markets rather than developed markets quite so much. So when the developed markets actually reopened, Unilever, relative to its peers, began to look rather dull. And obviously, emerging markets have taken much, much longer time to get over the hurdles of COVID than, for example, the UK and the US. So I think there's a relative issue here about performing well and then performing a little bit less well, which I think is a short-term issue. Having said that, we have engaged with Unilever on an ongoing basis, I think 3 or 4 times with the management in the last year, both meeting with the chairman, with the finance director and with the CEO. I think that it is a business which could do better. I agree with some of my peers that it could do a little bit better. I think that post the Kraft Heinz, as the chairman at the time called it, near-death experience, which would have been an absolutely disastrous deal and not good for shareholders in the long run. Certainly if we were going to take Kraft Heinz paper, which was clearly a disaster and needed to do a deal back then in order to keep its earnings moving forward. And as a result of not being able to do that deal, the share price at Kraft Heinz went down by, I think, 60+%. So I think that as a result of that, I think the Unilever management slightly went into rabbit in the headlights mode and slightly overreacted. They put in place a margin target, which was I would say, a little overambitious, so 20%. So they tied their colours to that particular mast. And I think that to some extent, the short term, the chickens have come home to roost from that perspective. But I think the damage is done. I think the management are back on form, or beginning to get back on form. But I think I hasten to add that we are very much engaging with Unilever. In terms of Medtronic, that's a little bit of a different one in that we like the medical devices area. It did perform very well initially when we bought it. It's performed a little bit less well recently. We had been hoping that with reopening of the economies and frankly reopening of hospitals in terms of hospitals not being focused on COVID, but actually serving its patients, their patients on all of the other issues that they use, particularly heart-related, cardiac-related issues, which Medtronic benefits from. We would have hoped and thought that would have recovered and bounced back, and frankly it hasn't. And so I think, whereas I think that Unilever will recover and we're more confident in Unilever, I'd say we're less confident in Medtronic, and that is more a holding that's under review. And we don't fall in love with our stocks. If things don't work out, we will reappraise them.
said a lot about the economic and financial risks facing all your investments. Could you just say a little bit about your thinking on the geopolitical risks, in particular your belief that America seems to be the best place to invest come what may? One sees that the political system there seems to be much more fractured than it was in 1981. And I just wondered if you know, in 10 years' time, will we find your investment still be as big in America, or will it be more switched elsewhere?
Well, yeah. Well, never say never, as Sebastian said. We may, it's impossible to predict the future, and some of the political events in the States are pretty concerning. I would agree with that. But ultimately, the business of America is business, and they just seem to do it better than others. And they have such a deep and rich and broad economy, and such an understanding of capitalism and how that works, that they tend to just have excellent companies, and we tend to therefore invest there. In terms of geopolitical risk, it's one thing you can just never predict. You can always work up a geopolitical scenario which is disastrous for everything, practically, but somehow the world muddles through. Now, the situation in Ukraine, which you didn't mention, is obviously just absolutely horrible and tragic, and is, I think, accentuating pre-existing trends, in the sense that I think it'll be that the oil price and food prices are higher than they otherwise would be, which means you'll have a bit more inflation in the short term, probably less inflation medium term, because it sucks demand out of the rest of the economy, and probably therefore a worse recession otherwise would have been the case. But you shouldn't really manage a portfolio based upon geopolitics. They're just far too unpredictable.
Do UK house builders feature in your meetings as possible candidates? Purely because recently a lot of the larger house builders have yields in single-digit 8% onwards. Persimmon Homes, I think last one I saw was about 12.5%. What are your thoughts on UK house builders?
Yes, the short answer is that they don't feature in our investment universe and our process. And I think it's a really good example. I mean, the house builders in the right conditions over a certain period of time can be very good investments. Typically coming out of a recession when you can buy them on a fraction of book value, possibly they're not even paying a dividend because they've had a difficult couple of years in a difficult housing environment. And then they really do motor and you do get incredible returns from them for a short period of time. The thing that we don't like is when I think about those cash flows, we would have to time investment into that. And right now we're at an interesting point in markets. And the house builders, there are the fundamentals that in the UK we are short of supply of homes. There is an underlying demand that will continue for housing. But the problem with the house builders for us is that going into difficult environments, when they do have those fixed land banks, when they have built and there's uncertainty as to the prices that they're going to be able to get for selling those houses, is the earnings and the dividends can be incredibly volatile. So I would say it's not one for us. Clearly you can make money from those, but you have to go into those with your eyes wide open in the way that you don't have to in many of the stocks that we own.
Following on from Blake's comments on house builders, could you give a brief rundown on the REITs you hold in your fund? Thank you.
Yes, absolutely. So two of them are, as I said in my presentation, Assura and PHP. We have two small holdings in those, about 1% in each. And those are the owners of the GP practices around the UK. They get paid their rent by the NHS. So incredibly recession-proof. They pay about 4% dividend yield, and there is some inflation linkage to those. We also own London Metric, which has probably been our best REIT investment over recent years. Many of you, I'm sure, will know the CEO, Andrew Jones, is one of the great capital allocators of UK property, and he has been fantastic at shifting his portfolio away from, for example, legacy retail assets into more urban logistics, which are really thriving at the moment, and even things like Starbucks drive-throughs and things like that, which are structurally quite well placed. So that's the biggest holding, about 2.5% of the trust. Again, pays a dividend yield of around 4.5%. should see nice inflation linkage there. And then we also own, in small weight, 2 of the self-storage companies. And this actually gets to the point on house builders versus another kind of property stock, which is Big Yellow and SafeStore. These are run again, and I think it's really important in property to go with the proven capital allocators. Both the CEOs and chairman of Big Yellow were the founders of the business. Similarly with SafeStore, the CEO who we met yesterday in our offices was the founder of the French business there. They've been doing this for over 20 years. And it's that it's the fact that in those businesses, we really like the fact that most of them are in London, incredible tight supply and demand dynamics, and that rent comes through in a very predictable fashion, usually even through a recession. So that's a collection of the REITs that we own. And then we also own 2 infrastructure companies, 3i Infrastructure, again, proven capital allocators in the utility and infrastructure space. And then finally, INPP, which is, again, a public infrastructure project in the UK, again, inflation linkage. So taking a step back, what do we want from our REITs, which is about, as I said, 8% of the portfolio, 8 to 10% of the portfolio. Really want bulletproof cash flows, bulletproof dividends, and we want capital allocators who we think are the best there are around.
So thank you all very much again for coming. As I mentioned at the beginning, it will be on the website, so you'll be able to watch the presentations again if you wish. And we hope to see you again next year.